Okay, good afternoon, everyone. Hello, everyone. Can we get started, please? Okay. Good afternoon, everyone. Welcome to your second last lecture in this unit. I'm very sorry to report that my throat has decided to go on strike, so I have partially lost my voice. I put the microphone on maximum, so we try to see how we go. So hopefully I can get through this lecture. You must by now have got back your assignment result, assignment mark. I've got your actual assignments down here. So if you want to come down to collect them during the break, please do so, because I really don't need them. So come down to get it during the break. They have been sorted alphabetically according to the surname. So I know that some of the Chinese students tend to get confused between the first name and the last name. So if you can't find your assignment, in a particular bundle, try another surname. Okay, so that's pretty much it. The other thing that I want to bring your attention to is the fact that the sample exam has been uploaded to DSO. So I think I did this last week. I can't remember when, but I think it was last week that it was up. The solutions to the sample exam will also be provided, but I do that 1 week before your exam. The reason that I do that is to make sure that you guys have a chance to look at the sample exam first before you look at the solutions. And if you want my advice, I would actually do all the revisions first before I sit down and do the sample exam, as if it were your real exam. So that would be my advice. And then compare your answers with the solutions. You can then form a very good idea of your overall performance. So that's pretty much the housekeeping thing. Today we'll be talking about corporate restructuring, and we'll be touching very briefly on bankruptcy. But most of the time we'll be talking about corporate restructuring. So there's a number of things that we are going to go through today. We talk about the reasons why a company would want to undertake some sort of restructuring. Then we're going to discuss different types of restructuring. And then we talk about private equity, which is potentially a very interesting topic, because you must have heard of private equity. Private equity is probably a household name in the last couple of years. So we're going to look at that. And to finish off, we're going to talk a little bit about bankruptcy. So, corporate restructuring. What is corporate restructuring? It is the redesigning or the reorganization of one or more aspects of a business. So that's a corporate restructuring. Sometimes corporate restructuring is in response to positive performance, good performance. It's the situation where the company has been growing so fast and therefore the current structure doesn't work anymore. It's not efficient anymore. That's why the company has to restructure. But most of the time, corporate restructuring is in response to poor performance. So things are not going very well. That's why the companies have to look at things, look at doing something to improve the whole situation. So when you think about corporate restructuring as a response to poor performance, there's a number of reasons that it can take place. The first reason is to correct a mistake. So obviously, management did something in the past which didn't quite work, so it's time to correct that strategic mistake. It can also be because the company wants to convey some information about the value of a particular business division. So this is when they separate that business division from the parent company. Because when we talk about the different types of corporate restructuring, then you probably understand this more. Because one popular way to restructure a company is to separate a business division from the parent company and make it an independent company. So by making a division an independent company, the parent companies can actually convey to the market the value of that particular division, because then that particular division will be trading as an independent entity, and therefore, by looking at the share price, you have a good idea of what the value of that division is. And finally, which probably most importantly, In most situations, corporate restructuring is undertaken to improve the profitability and efficiency of the whole organization. So most of the time you see that the companies have to restructure something because it hasn't been performing very well, and therefore it has to take some drastic measure to improve the overall performance. So that's really common. Okay, so corporate restructuring can be simple. It can be just the reshuffling of assets, but it can be something a lot more complicated, such as the creation of a new entity and therefore new ownership relationships altogether. So those are the type of restructurings that we are going to look at today. Some of them are voluntary decisions. So some of the forms of restructurings up there are undertaken by management voluntarily. Some other forms of restructuring, such as a leverage buyout, is not undertaken voluntarily. They are being forced into it. So another party, a third party, took over the control of the business pretty much. So some are voluntary, some are not so. So we start with the first type of corporate restructuring, which is a divestiture. Divestiture is, of course, just a fancy name for asset sale. So when a company divests something, it is selling assets to a third party. Most commonly is a business segment that is selling. Well, the company, this is a voluntary decision, by the way. So this is a form of voluntary corporate restructuring. It might occur because management just doesn't have the skills or the expertise to manage a particular division, although they would never admit so. But that's one reason. The other reason is by selling off a business segment, management can actually focus on the business that it has a competitive advantage in. So it provides a sharper focus for management as opposed to trying to spread themselves over many different business divisions. And finally, the other reason is it related to management performance as well. So this gives the management team a very good incentive to get rid of the poor performing division. So poor performing division that is not a good fit to the rest of the company is usually divested. Now this is a good example that took place very recently is that of Citigroup. Citigroup earlier this year actually divested its life insurance company. It's a company called Primerica. I don't know whether you heard of it. So it's the third largest life insurance companies in the US. So Citigroup decided to get rid of this, this particular division because it doesn't fit in very well with the strategic direction of the company. So they decided to sell that off to a third party. That allows them to focus on the other areas of business. Now, it's not because Primerica is not performing well. It is actually performing well, but it's just not a good fit with the rest of the company. So that's why Citigroup decided to divest that segment of the business. Very commonly, divestitures also arise because of poor synergy from previous merger acquisitions. If you recall from last week, we were talking about conglomerate mergers, and in a conglomerate mergers, companies take over another company which is in an unrelated area of business. Many of them just didn't seem to work. Very poor synergy didn't work, and therefore they end up selling off those companies that they, took over previously. Sometimes it looks good on paper, but just doesn't work, and that is an example of Daimler Chrysler, which is the automaker, the cars maker. In 1998. Daimler, which is the German automaker, took over Chrysler, which is the US automaker. Now, it sounds like a very good merger because the two companies are in the same area of business. They're both producing cars, and therefore you would expect to see synergy in the forms of economy of scales. But it just didn't work because there was a big clash in the management styles. Daimler is German, Chrysler is American. The American managers is completely different from the German managers. They just can't seem to work together at all. So following the mergers, Chrysler just suffered from years and years of very poor performance And at the end of the day, in 2005, Daimler has come to a very painful decision to divest Chrysler altogether. So they sold off Chrysler to a private equity group, and they were really desperate to get rid of Chrysler in such a way that they actually have to inject some cash into the company before they can sell it off as a sweetener. So as you can see, divestiture can be a strategy to correct something that you did wrongly in the past. It just didn't work, and therefore you have to admit that it doesn't work, we have to get rid of it. Now, as you can see, when a company voluntarily engages in this form of restructuring, it is making an effort to make things better. It is making an effort to make the whole things more efficient. So overall, whenever a company engage in corporate restructuring, the market welcomes the news as a very positive news. So whenever there's an announcement about a plan to divest certain asset, you see a significant increase in the share price. And it also seems that the asset that's being divested is being used more efficiently by the third party who buys it. So overall, this is a good thing for the company. The other type of corporate restructuring that the company also undertakes voluntarily is a spin-off. Now, a spin-off is, it's not technically an asset sale, but it is a separation or detachment of a business segment from the parent company. So essentially, in a spin-off, you are creating a new business entity with its own assets and liabilities, with its own management team, which is separate from the parent company. So that's what happens in a spin-off. Now, the reason for a spin-off is usually, again, to allow management to focus on the business segment that it has a competitive advantage in. Again, it provides a sharper focus for management. And this is the example of Foster Group. Foster Group is an Australian-owned company. It's based in Melbourne. It's the largest liquor maker in Australia, and obviously is the owner of some very well-known brand names. And if you are drinkers, you probably know this more than I do. It's the owner of Victoria Bitter, VB, and it has some well-known wine brands as well. So Foster's has two main business divisions. It has the beer divisions and the wine divisions. The wine divisions was acquired by Foster's in, I think, 2005 or 2006 by taking over South Corp, which is the wine producer. So Foster took over South Corp in 2005 with an aim to get into the wine market. But it seems that the wine market is just too competitive. As a result, in the last 5 or 6 years, Foster's hasn't been doing very well at all, especially in the wine division. So earlier this year, in March this year, it has decided to spin off that wine division. So it spin it off and focus on the beer division instead of trying to do both. So again, when a company is trying to spin off a business division, it is considered as a good news because the company is trying to have a sharper focus, try to improve the things that to improve the current situation. Now, the thing about spin-off in terms of the ownership relationship is that when you spin off a company, the shares in the new companies, in the spun-off companies, goes to the existing shareholders. So if you are the shareholder of the existing company, let's say Foster's, then instead of having shares in one big company, after the spin-off, you have shares in two smaller companies. So that is how the ownership structure works in a spin-off. So essentially, you have a new company, but same set of shareholders if you want, because the shares in the new companies goes to the existing shareholders. Very similar to a spin-off, you've got a carve-out. They are really, really similar, and the way that I see it, the difference between spin-off and carve-out as a form of corporate restructuring is a very technical one. And the technical one is in terms of the new owners of the separate company. So in a carve-out, you also create a new company, a new independent company with its own management team, with its own assets and liabilities, except that in a carve-out, shares in the new company are partially offered to the public as well. So in a spin-off, no new shareholders at all. In a carve-out, you get new shareholders because some of the shares are being offered to the public. However, in most situations, the parent companies would retain the majority of the shares in the carve-out company. There's no legal obligation for them to retain the majority of the ownership, but they choose to do so because of a tax reason. And the tax reason is if the parent company retains at least 80% of the shares in the new company, then the two companies, although traded independently, can be considered to be one entity for tax purposes. So only one set of income tax. Whereas if they retain less than 80% of the shares in the new company, then the two companies will be taxed differently as two independent entities. So as you can see, they are very similar, a spin-off and a carve-out. The difference is only lies in the ownership of the new company. So in the situation of a spin-off, you've got existing shareholders being the shareholders of a new company as well, whereas in a carve-out, you have some new shareholders being the public. So the public can be institutional investors, they can be financial institutions, or they can also be individual investors like us. So divestiture, spin-off, carve-out, they are all voluntary decisions by the company to restructure. The next form of corporate restructuring that we're talking about is only relevant to government-owned entities or enterprises, and that is privatization. Now, I'm sure that I don't need a lot of explanation in relation to privatization because I'm sure you have a very good understanding of what it is. So the process of privatization essentially transfers the ownership of companies from the government to the private sector. So when I say the private sector, it can be other companies, it can be financial institutions, it can be individual investors. So it can be anyone which is non-government. So in a privatization, ownership transfer from the government to non-government investors. And of course, privatization is commonplace in every single country in the world. So no matter which country that you look at, you can probably name an example of privatization. In 2003, the Thai government privatized Thai Airways. Previously, it was owned by the government. Nowadays, it's privately owned. In Australia, obviously, the most well-known privatization is Telstra, so that's the most well-known. And in China, I'm sure that you know that in the last couple of years, there has been a lot of privatization going on. A lot of government-owned enterprises, issue shares to the public, and in the process, transfer the ownership from the government to the private sector. There are a number of reasons why privatization takes place. The most important reason is to improve the performance and the efficiency of the enterprise or the company. The reason that it is becoming more efficient is because when a company is privately owned, it has to face competition. So it is competing with other companies in the marketplace to make a profit to survive. So without the government ownership, they no longer have the subsidy, so they really have to compete. Efficiency can also be improved by avoiding all the political agenda. So it can be competing in the market as a player like any other companies. It's not impacted upon by whatever the central government might want the company to do. So two forms of improving efficiency. First is to open up the company to competition, and the second is to avoid political agenda. So that's the most important reason to privatize a company. But there's other reasons as well, and that is to encourage individual share ownership, because obviously when a company is privatized, individuals, investors have an opportunity to own the company. And last but not least, privatization, it provides a very good source of revenue to the government as well. So depending on what sort of budget situation the government is in, this provides a very welcome source of revenue. But overall, I think the most important reason is the first one, which is to improve the efficiency of the company. Because, I mean, this might be a stereotype, but more often than not, government-owned companies do not seem to be very efficient, just because they know that they always get the subsidy from the government. Even if it fails, it always gets bailed out, always money there for them. So they don't tend to be very efficient. So up to this point, we've been talking about voluntary forms of corporate restructuring. So this is when a company decides to engage in these changes, in their own will. But some other times, the form of corporate restructuring that takes place might be involuntarily. So this is the situation in a leveraged buyout. So a leveraged buyout is essentially a takeover. So in a leveraged buyout, the company is being taken over by a third party, but a leveraged buyout is different from a normal takeover in a number of ways. The first difference is there's always a large proportion of leverage in a leveraged buyout, hence the name leveraged buyout. So the party who buys out the company borrows very heavily to finance the takeover. So that is one distinctive feature. The other distinctive feature of a leveraged buyout is the fact that once the company is being bought over, it's going to be taken private. Whereas with a normal takeover, even when you take over another company, you continue as a listed company. With a leveraged buyout, they disappear from the stock exchange, they become a private company. So there are two main distinctive features of a leveraged buyout. One is there's a lot of leverage, and the second is that the company has become a private company after the buyout. There are three main sources of gains or value addition in relation to a leveraged buyout. The first is the existence of the junk bond market. When you talk about a junk bond, you are talking about a bond that is risky. So a junk bond has a credit rating which is below investment grade. So you've got two concepts. You've got investment bond, which is considered to be safe, and then you've got the junk bond, which is considered to be very risky. So the existence of the junk bond market makes leveraged buyout possible, because it allows the parties that involve in leveraged buyout to borrow money to finance the transaction. So that's the first source of gain. The second source of gain is the tax shield, because whenever you borrow money, you actually get an interest tax shield. I mean, we discussed this in previous topics, so you know that whenever you borrow money and if you pay tax, then you get tax shield. So the tax shield is the second source of gain in a leveraged buyout. But the last one, which is probably the most important one, is the incentives that managers have to work efficiently when there is a high level of debt. So whenever we are talking about the incentive factor associated with leverage, we're talking about the fact that when a company has a lot of debt, it has an obligation to service those debts. I mean, when you borrow, obviously you have to pay interest. So that is your obligation. It's not something that you can choose to do. You have to do it. So when you have a huge amount of debt that you need to service, and if you're the manager of the company, you are under pressure to produce enough cash flow to at least meet all those interest payments. So because of that, you are under pressure. You have to work smarter. You have to work more efficiently. So the minimum that you do is to produce enough cash flow to pay the debt. So that is referred to as the incentive of leverage. The incentive here is that the managers cannot sit back and relax. They have to work hard to ensure that the company is profitable, to ensure that the company has enough money to pay all the debt holders. So those three reasons explain the popularity and the success of leveraged buyout in the last couple of decades.
LBOs be a source of value for
I think when I talk about the source of value here, I'm talking about the reasons that make it possible for LBO to create value. So yes, so that's the direction of the impact. Now, so I hope that you see that in a leveraged buyout situation, there is a change of ownership, a change of control. So there's a change of control because the company is being taken over by a third party. And as you can see, obviously, the company that can be a target for a leveraged buyout is firms that are not currently being run very effectively. So, I mean, if the company is doing fantastically well, is, share price increasing every second day, there's no reason for any, I don't think you can create any additional value than that. However, if the company is not doing very well, might be because of management, might be because the structure is not optimized, it might be something, but obviously the company is not in the best situation. So if that's the case, then it can be a target for a leveraged buyout. Now this slide just gives you an example of how popular leveraged buyout is. Now, I mean, the value of leveraged buyout, whether it's a good thing or a bad thing, really depends on whose perspective you are talking about. Because leveraged buyout can potentially add value, because what it will do is it take over the company and then fix it up. So, improve it in one way or the other. So it can be a good thing. But if you are the management team or if you are the employees of the company that's being taken over in a leveraged buyout, you probably have a different idea. You probably don't think that a leveraged buyout is a very good thing. I don't know whether you know, but there's a movie, a Hollywood movie that talks about leveraged buyout, Barbarians at the Gate. I haven't seen the movie, but I've heard of it. So obviously, leveraged buyout is portrayed in that movie to be, a bad thing, because all the people who engage in leveraged buyout tend to be ruthless investors who's after money, nothing else. So this, again, back to this slide, just tells you briefly about the type of companies that have been taken over in a leveraged buyout, the time frame, and also the value of the deal. So a lot of companies have been taken over. A lot of money is being involved in these transactions. Very similar to a leveraged buyout, but it is a voluntary decision by management. It's what we call leverage restructuring. So in a leveraged buyout, obviously the management team and the employees of the target company, well, I mean, most of the time they probably do not want to be taken over because it might mean loss of jobs. But similar to a leveraged buyout, a company might choose to restructure voluntarily. So in a leverage restructuring, what the company might do is that it changes the capital structure, essentially increasing leverage. So usually it will issue a lot more bonds and use the money to repurchase the shares. So in the process, it increases the amount of leverage significantly. So why would a company want to do anything like this? Now, most of the time, the sort of company who would like to engage in this sort of leverage restructuring is companies that are cash cows. So company who makes a lot of money without sufficient investment opportunities. Because, I mean, if you have you have investment opportunities to put money in, then it's not an issue. But the free cash flow can become an issue if the company does not have enough investment opportunities to invest in, because that's the situation where the agency problem becomes most pronounced. The management has a lot of money under their control and they don't know what to do with it. So that is the situation where the agency problem manifests itself. So in that situation, the managers who act in the best interest of the shareholders might choose to undertake a leverage restructuring, increasing the debt, using the money to repay the shareholders. So once they've got a huge amount of debt sitting there, they have a lot more pressure to work better, to work smarter, to work more efficiently, to produce enough cash flow to repay the debt. So in terms of the incentives of leverage, this is very similar to a leverage buyout. So they're similar in the form of incentive that it provides to management, But it is different because one is an involuntary decision sort of thing, whereas this one is voluntary. They want to do this. The other thing which is quite different is that with a leverage buyout, the company will become private. After the leverage buyout, the company will become private. Whereas with a leverage restructuring, after the restructuring, the company has a lot more debt and less equity, but it remains a listed company. So although the incentives that they provide are similar, there are major differences between these two forms of restructurings. So that's pretty much the major forms of restructuring that we consider. Now, when I talk about leverage buyout, I keep referring to that third party who takes over the company. Who's that third party? Most of the time, that third party is a private equity fund. So what is a private equity fund and what it does? So private equity fund is essentially a fund, okay? It's a fund, it raises money from investors. So investors are institutional investors, might be financial institutions who put money in, they might be trusts or endowment funds, they might be pension funds, they might be very wealthy individuals, so they are generally classified as investors. Now investors put all this money in the fund, and the fund will then use the money to make investments in privately held companies. So it is different from other form of investments because it only invests in privately held companies. So it's not going to invest in shares of Telstra or Qantas. They're not going to do that. They're not going to invest in publicly listed companies. They only invest in privately held companies. That's why they are referred to as private equity funds. There's a lot of activities that involve private equity funds in 2006 and 2007. As a matter of fact, I think 2007 was the record year for private equity funds because probably every second week you probably hear something in the media that involves a private equity fund. It might be a merger acquisitions, it might be a leverage buyout, it might be an IPO, but it involves a private equity fund. But then in 2008, or late 2007, early 2008, the global financial crisis hit, and then investments from private equity funds took a dive. But I believe that as the global economy recovers from the crisis, we'll probably see an increase in private equity transactions again. Two main types of investments that private equity funds tend to make. The first type of investment is in venture capital funds. And the second type of investment is in leverage buyout. Now, venture capital funds specialize in investment in young startup companies. That's why it's called venture capital. Now, I think you probably touch on venture capital when you talk about the sources financing, so probably this is week 5 or week 6. But the thing that you probably take on board is the fact that venture capital investments are incredibly risky. They are very risky, but they have incredibly high expected payoff. So they're risky because essentially you are investing in a company that is so new, there's no guarantee that it will be successful, and your investment is essentially very illiquid. Because, if tomorrow you change your mind, you don't want to invest anymore, you can't really sell it because it's incredibly illiquid. So it's risky, it's illiquid, but if you hit the jackpot, then, the payoff is incredible. One example is, I don't know whether you heard of this guy, Peter Thiel. He's one of the co-founders of PayPal. He sold PayPal to eBay, and then he invested $500,000 in Facebook back in 2005, I think, for a 10% ownership in Facebook. So it's 10% back then, and the company is now worth at least $3 billion. So he's turning a $500,000 investment into a $300-400 million return. Now, but of course, that's when he hits the jackpot. He might have 10 other investments that never make it because with this sort of investment, you don't know whether the company is going to be successful or not. There's simply no track record. You have to go with the business, you go with the business proposal. Some of them sounds wonderful, but just do not work. So they are incredibly risky. So that's the first destination of private equity money. First destination is in all these new starting up companies. The second destination of private equity money is in leverage buyout firms. So actually 2/3 of the monies of the private equity firms actually go to leverage buyout. So they use the money to spend or to buy companies that have a potential to deliver value. So as I mentioned, these companies they have potential. So obviously they have a very good core business, they're just not very well run. So that is when they create value. They just buy over this company, fix it up, sell it, make a profit that way. So this is how a private equity fund is set up. And I have to mention that it is set up as a partnership. So it's not a company, it is setting up as a partnership. So there are two main partners in a private equity fund. You've got the general partner, who is essentially the management team. They put in 1% of the capital. And then you've got the limited partners, who are the other contributors of the fund, who put in 99% of the money. So you've got two main partners here. Now, the thing about a partnership that is so different from a company, I'm sure you know, is the fact that there's no separation between ownership and management. So with a private equity fund, the managers are also the owners of the business. So in this case, the general partner runs the equity fund, but he or she is also an owner in the fund. Now, in exchange for the management service, they get a management fee, which is usually fixed. So it's like an annual salary. So they get an annual salary, and then their job is to use the money and identify profitable investment opportunities to put that money in. Depending on whether it's a venture capital fund or it's a leverage buyout fund, it can be identifying startup companies to put money in, or companies that are already established but there's potential for improvement. So they identify those companies and buy those companies. So with a private equity partnership, the end result is they end up with a portfolio of companies. And these companies do not have much in common in terms of their operation. So they might be doing completely different things, but there is one thing in common in all of them, and that is the potential that the management team sees. So they need to be able to see the potential in this company in order to put the money in them. So diversified companies, a portfolio of diversified companies. So this is what happened when they get the money and how they spend the money. Now this is how they get their money back. Another distinctive feature about a private equity fund is that all investments has an expiry date. So all of it has an expiry date. Unlike a company, when they make an investment, there's no expiry date, which is assumed that it's an ongoing investment. It might last in perpetuity. With a private equity partnership, all investment has an expiry date. It means that they will sell the investment at some point in the future. Now, once they sell the investments, and if they make money, this is how it is distributed. The general partners get 20% of the profits, and then, of course, the limited partners get their money back plus 80% of the profit. Now, the point that I would like to highlight is the fact that if you think about the general partners here, the general partner, although an owner, is also a manager. So he or she gets a fixed management fee every year, so an annual fee, an annual salary, plus 20% of profits. So if you think about it, this payoff resembles that of an option because it has a limited downside. No matter how bad the investment turns out to be, he or she still gets the management fee. So still get that, the salary. But there's a lot of upside potential. the more profits that is being made, the more money he or she is going to take home. So the payoff is, the base is the management fees, and then it just keep going up. So that payoff is very similar to that of an option. Now, why do I say that the payoff to the general partner is similar to that of an option? Because I want to get to the point that when they have an option, or when they have a payoff which is similar to that of an option, they have a lot of incentives to take risk. Now, I'm sure that you understand this point. Whenever you have an option, if you just forget about the premium, let's say it's a sunk cost, once you hold the option, you have a lot of incentives to take risk, because you have a lot of upside potential, but your loss is limited. You can't lose more than the premium. In this case, no matter how bad the investment is, they still get the management fee, whereas there's a lot of upside potential. So the general partners, they have a lot of incentives to take risk, and obviously that probably explains the two types of investment that they make. Both of them are incredibly risky. So the first one, which is a venture capital fund, I already explained that it's very risky. As a matter of fact, statistics in the US shows that only about 1/3 of all the companies that receive venture capital money end up being successful. So 2/3 will fail completely. So you put money in, only 30% of the time you get a profit. The rest of the time, it's just your money going down the drain. This is very risky. The other form of investment, which is a leverage buyout, is also risky because it involves a high level of leverage. So you have a lot of financial risk there. So everything kind of click because the general partner has an incentive to take risk, and that is evident in the forms of investment that they make. So that is the basic structure of a private equity fund, and it's quite important that you understand the important features of a private equity fund, because later on what we're going to do is we are going to use this to compare with a public conglomerate, and we try to see why a private equity fund appears to be a lot more successful than a public conglomerate. Blackstone is one of the biggest private equity funds in the US. And this is just a snapshot to show you the type of investment that they make. So obviously, this is a leverage buyout fund because they make investment in established companies. So as you can see, the investment are totally unrelated. So these companies are doing entirely different things, from software to telecom to packaging to insurance to media. So this is their portfolio in 2007. As I said, private equity, all those make investments in unrelated business, appear to be a lot more successful than a public conglomerate. Public conglomerate, we seem to have seen the demise of them, because most of them have divested all the smaller businesses, except for a few exceptions like General Electric that remains very successful. Most of them have divested all the smaller companies that they bought. Private equity funds, on the other hand, seems to have experienced a lot of successes, especially prior to the financial crisis. I don't have more up-to-date figure, but in 2005. Private equity funds manage about $1.5 trillion in capital. So that's a lot of money. And obviously, this is just the equity that they put in. And when they go and borrow money to invest in leverage buyout, the amount of money under their management is being multiplied significantly. So a lot of money at stake here. Pretty much, 1/3 is venture capital fund, and 2/3 are leverage buyout. And of course, venture capital funds are responsible for many successful companies that we see today. Some examples of them include Google, Facebook, as I mentioned, Skype in Europe. So without private equity firms, we'll probably never see these companies, because thanks to private equity money, these used to be small companies grow to where they are today. Now, I'm sure that you probably understand the information that I put on these slides, because if you understand the way that the private equity funds make investments and realize their profits, you understand why they account for many of these global transactions. They account for a large number of transactions in merger acquisitions because they buy over all these companies in their LBO, leverage buyout. So they account for a lot of transactions in the merger acquisition market. They also account for a lot of transactions in the loan market, loan and high, the debt market. Why? Because they borrow money to finance all this leverage buyout. So they are a very active player in the debt market as well. And at the end of the day, once they make the investment, as I said, they all have an expiry date. So 4 or 5 years down the track, all the investments have to be sold. And one common way for them to sell up the investments is through an IPO. Now, sometimes it will be a private sale to one buyer, but because many of these companies are fairly big, a very common way for them to sell the investment is through an IPO. So that's why private equity funds are responsible for a lot of transactions in the IPO market as well. So through the types of investments that they make and through the way in which they realize their returns, private equity play a very significant role in the financial market. I mentioned a little bit earlier about the impact of the global financial crisis on the activities of private equity funds. This graph once again confirms the impact of the global financial crisis on private equity funds. So what it's telling you here is the value of leverage buyout all over the world. So global buyout deal, it tells you the value of the transactions. And all the numbers here are in billions of dollars. So as you can see, in 2007, the leverage buyout activities account for about $503 billion. And these are the destinations of the money. The majority of them, the black column here, is North America, so US and Canada. And then you've got Europe here. And then you've got Asia Pacific. And then the rest of the world. So if you look at this graph, you can see that there's, a significant dive in the amount of transactions from 07 to 08, and even further in 09, so a significant drop. And also the other thing that you can see is that the majority of the money currently going to the US and Europe, but certainly in the future. I think I read in one of the articles recently that this year China is the top destination for private equity money. So if I have any further data, we probably see more money going to Asia, particularly to China and to India. In Australia, of course, we all know that there's a very well-publicized leverage buyout, and that is of the Myer Group in 2006. So in 2006, Myer was bought over by an American private equity group, TPG. So TPG is another very big private equity group in the US. They bought Myer from Coase Myer and subsequently took Myer private. So Myer became a private company. So following the buyout, what they did is they actually spent a significant amount of money to improve the value of Myer. There are two things that they did. They spent money on renovating the stores, so giving all the stores a new look. And the second thing that they did is to improve logistics operations. So they do spend money to improve the value of the company here. So just 1 year after the takeover, Myer announced an increase in earning before interest and tax of 84%. So whatever the private equity group was doing, it seems to have worked because earning before interest and tax has gone up significantly, and the profit margin almost doubled. So it seems to be working very well. And with a private equity fund, once the company is being fixed up, once it has added value, what do? They sell it. So it's not like they're going to hold on to it forever. They put Maya on the market again, and in October 2009, so probably a year ago, Maya was put in the market through an IPO. It was quite well publicized as well. The prospectus has Jennifer Hawkins, on the cover page. Well, I don't know whether it did a very good job at attracting buyers that way, but she was on the cover page looking very glamorous. The IPO raised $2.4 billion, and comparing to the price at which TPG bought Maya about 3 years earlier, they made about $1 billion in gross profit. So that's not too bad. It's about $300 million a year, so that's pretty good. So this example about Maya illustrates very well the operation of a private equity fund. So they buy companies, they spend money to fix it up, they sell it again, making a profit in the process. So a number of important characteristics of a private equity fund that I would like to draw your attention to. I guess the thing that I need to point out is that a private equity firm has a portfolio of companies that are in totally unrelated businesses. So these companies are independent, totally independent in what they do and in the way that they managed. Each of these companies has its own management team, but obviously the management team receives direct instructions from the management team of the private equity funds. So two-layer management here. You've got the management team of each of these companies, but then you've got the management team of the entire private equity fund. The management team of the entire private equity fund obviously has the final say, so they decide what's to be done. So all of them, although they are unrelated, they contribute to the return of the private equity funds in general. So they're unrelated, but they do contribute to the overall return. The reputation of the private equity funds partner is actually very important, and this is more so in venture capital funds, because with venture capital, it's not just about money, it's also about experience and expertise. Because a lot of the time, private equity funds put money in venture capital firms, but they also provide a lot of advice as well. Like for example, with Facebook, when Peter Thiel put $500 million in there, it's just not the money that he provided, because he set up PayPal. So he went through the process. He knows he knows all about it. He's been there, done that. So it's just not about the money. It's also about the expertise, about the experience. So in that respect, the reputation of the private equity partners are quite important. And in private equity firms, the CEO have a boss. So the boss here are actually the limited partners, unlike almost all other public corporations where the CEO is the boss. Because all the companies which is part of the portfolio of a private equity funds are totally independent, so obviously all of them have different debt equity ratio. Essentially, they're separate companies, so they have nothing in common except for the fact that they have the same owner, being the private equity fund. So they run quite independently. They have their own debt equity ratio. But probably one thing that they have in common is that most of them have a very high debt equity ratio, just because following a leverage buyout, there's a high level of leverage involved, and therefore all these companies take over the debt, and they do have an obligation to repay those debts. I mentioned a bit earlier that if you think about the type of investments that a private equity fund make, then it's actually quite similar to a public conglomerate, because they also make investments in unrelated companies. But unlike a public conglomerate, private equity funds appear to be quite successful, because it has been consistently providing the owners or the partners with very good returns. Unlike public conglomerate, who has suffered from sluggish share price performance, leading to the divestiture of many of the smaller business segments or the spin-off during the 80s and 90s. So what we want to see here is, why is that the case? Why is it that we have the same set of investments, but one appears to be a lot more successful than the other? Okay, so if we look at this comparison, hopefully we can shed some light on why a private equity fund is a lot more successful than a public conglomerate. Now, the thing that they have in common is the first point there, and that is they both make investments in diversified, unrelated companies. So that's the thing that they have in common. But apart from that commonality, everything else different. And I guess the way that the partnership is structured and the way that they return the investments to the owners make all the difference here. Now, first of all, a partnership has a limited life, so it's not an ongoing entity, so it's just not keep going forever. So that means that each of the investment has an expiry date, so it will be sold at some point in the future. The common time frame is probably 5 to 10 years, so a private equity funds only hold investments for 5-10 years, they sell it off, realize the profit. Whereas with public corporations, they are ongoing entities that just keep going. So you know, if you want to realize your profits, then all you have to do is probably sell the shares and move on. The second point, which is quite different between these two forms of organizations, is that in a public conglomerate, you have an internal capital market. Now, internal capital market, in many circumstances, are argued to be a good thing because if it's a big conglomerate, a business segment that is very successful can produce a lot of money. The money can be used to finance investments in another division which has a lot of growth but no money. I think that's a signal that we need to go for a break. We just have a brief break, and if you want to come down and get your assignment, please do.
Okay. I'll ask you a quick question on you don't say about private equity, about general partner versus limited partner. So private equity come in, they'll put the deal together, they'll bring in a management team, they'll incentivise the management team by saying they put some skin in the game, they put a bit of their personal wealth in so that they have a ownership. Is that the 1% contribution?
No, it's not.
So,
Well, I mean, depending.
Does general partners mean the management of the firm?
Of the private equity fund, and then each of these companies has one team.
Right, so the actual management team sits down here.
I mean, when they take over the company, they might maintain the previous team, or they might put in a new team. But each of these companies has one team. All of them receive instructions of the change.
Because the management team can be very highly incentivized.
Well, I mean, these guys are, because they get profit. These guys will probably have an incentive to keep their job, because if they don't, they might lose their job. But yeah, I mean, of course, they get to keep their job and they get whatever compensation they get.
So that's not the CEO there, the CEO is not here.
So yeah, each of them.
Okay. Right, thank you.
No worries. Yeah, I can see that you actually have one. So yeah, it should be okay. I speak to my school, but it should be okay. That's okay. Hi.
Yeah, you are not completely answered. Who is up you?
Maybe you should email me if that's the case. It belongs to you. Right. And I don't need them. I consent.
Thank you.
Bye.
Direct just investment and what all they can just watch the things like factory.
No, they don't set up anything. They do venture capital, or they do development. So they don't do the actual investment initial companies do. They just buy and try business.
That's why you mentioned the CEO was limited partner of the private. But what CEO was like management, like management level.
There are two levels of management. Yeah, this one.
Okay, oh yeah. That's your level, yes.
Mhm.
The level of the
Okay.
private equity.
So this guy is the management team of the whole private equity firm, and each of these companies would have their own management team, but they receive instructions from this guy.
Okay.
So yeah, so,
So-
they have management team in each of these companies as well.
So the private actually when it goes international, it can be a problem of the global of the local market, is it? I mean, it's just
I mean, they can buy, this company might
Yeah.
be in China,
Yeah.
and they might have a Chinese management team,
Yeah.
but these guys provide the general strategic directions.
Okay.
What's your surname? What's your family name? And it's not in there. And what's your first name? Try K. Okay. Hello, sister.
Right, everything except this one.
7 out of 10.
That one is only one.
So that should be 18, right? And you
Yeah,
got
but
9.
they say I'm wrong for one question. But I didn't find the whole thing. So how many months?
How many months is question 5? Do you remember? 10 months. What I get you to do is compare this with the solution, because most people have a solution. So compare that with the solution. And if you're still not happy, then come back and then we will have a look at it. But yeah, compare.
But the thing is, yeah, I know it's wrong in that key question. But how come I got 3 marks deducted?
Is it 3 marks here? Is this part worth 3 marks?
It's got H. Yeah.
So again, look at the marking guide first. Okay, I really need my cover sheet for each of the bundle and the rubber bands back, please. So if you have any of those, can you quickly return to me, please? Because I don't know where they've disappeared. Okay, let's get back to this. So the rest of the assignment will be available for collection either in my office or Michael's office during our consultation times. But I think I'm just saying that for people who are not here, who are listening to the lecture, because you must have already collected the assignments. Right, okay, so we're talking about the internal capital market. Now, the argument for the benefit of the internal capital market is the fact that if you have multiple divisions in a company and one is a cash cow, then that division can produce the money to be invested in another division that is experiencing a lot of growth without having the money to finance the growth. And they argue that it can be valuable because it means that the company does not have to go outside to raise external finance. And you know how expensive to raise external finance because all the direct costs in the forms of, whatever that you have to do, all the admin costs, they're expensive. And with equity issue, they're particularly expensive because not just the direct costs you have to be worried about, you also have to bear the indirect costs in the form of underpricing. So that's the argument. But the disadvantage of internal capital market is that sometimes it doesn't work that way because division who makes a lot of money tends to have a lot more bargaining power. And it means that the division that are cash cows tend to get a lot of money compared to the other divisions that should be getting the money but don't. So although in theory the internal capital market argument sounds pretty good, but in practice many companies see that there's a political agenda behind the distribution of funds and therefore the money does not go to the division that most needs it. As opposed to the, to the public conglomerate, you can sorry, I need a time out. Okay, sorry, I might be good to go. I might be good to go for another 5 minutes and I might have to take another time out. So with the private equity funds, there's definitely no relationship between the divisions at all. So that means that the money is not being transferred from one division to another, therefore doesn't give rise to any wastage because any profit that is being made by each division goes straightly back to the private equity fund. It's not going to be channeled to finance a loser or a losing division. So that's the second thing about the relationship between the divisions. In terms of the monitoring, with the private equity funds, you've got the general partners monitor, and of course you've got the lenders who monitor as well because there's a lot of leverage involved in these leverage buyout transactions. Over here, a public conglomerate, you've got hierarchy of corporate staff, corporate people who evaluate the plans and the performance. And then with the compensation, in a private equity fund, because everything has an expiry date, the manager's compensation really depends on the exit value of the company. So in particular, they get 20% of the profit that they make on each of the transaction. Whereas with a public company, most of the time it depends on earnings. So I guess there are two main important features that clearly define a private equity fund and that possibly makes it more successful than a public conglomerate as well. And the first feature is that there's no agency problem here, because you have no separation of ownership and management, so you don't have to worry about monitoring the activities of management. So that is very important. So the second is, because all the divisions are independent, you don't have a free cash flow problem. You don't worry about money being transferred from one division to another and therefore being wasted. And also in relation to the free cash flow problem, because all investment has an expiry date or maturity date, the money will be returned to the investors, in this case, the limited partners. So even the general partners cannot reinvest the money. It has to go back to the limited partners. So in that sense, there's no free cash flow problem. There's no reinvestment here. And finally, the point that I want to make about private equity is that it plays a very important role. It plays a very important role in the financial market because, through what they do, through the type of investment that they make. With venture capital fund, they're responsible for the birth of young companies via venture capital, because without venture capital, we won't see many of the successful companies that we see today, and many of them I gave an example of. And it's also responsible for the rebirth of many old and faltering business via the leverage buyout. Because when they do leverage buyout, they usually improve the company one way or the other to make it, more successful. And of course, it really depends on whose perspective you're talking about. So if I'm just trying to be objective here, I think that the private equity fund is quite important. But of course, as I said before, if you are the management or you are the employees of the companies that are being taken over in an LBO, you might have a different opinion. The last couple of slides, just to briefly touch on bankruptcy. I don't know whether it's a fitting finish for the unit when we're talking of the demise of the company, but we briefly talk about that anyway. Obviously, firms are forced into bankruptcy when it's not able to repay the debt, because debt repayment is an obligation. So if you do not make good on your obligation, you'll be forced into bankruptcy. But many of the financial institutions, when they face bankruptcy, they actually get bailed out by the government because of what they call systemic risk. So systemic risk is the risk that if one financial institution fails, it will lead to the failure of another financial institution and therefore of the overall financial system. So that is systemic risk, because the whole system works on confidence, investors' confidence. Now, the reason that we put money in a financial institution is because we know that they would be there when we want our money back. If we think that there's a risk that the company will go bankrupt, taking our money with it, then you'll be knocking at the doors of the bank trying to get your money back. And if that happens, the collective withdrawal of all the money out of the financial system will cause its collapse. So many of the financial institutions are actually bailed out by the government. But which one gets bailed out and which one doesn't get bailed out is, of course, another interesting question. Because last year, AIG got bailed out by the US government. AIG is the insurance company, you know that, and they got into a lot of trouble with their credit default swaps contracts that they've written. They lost big time on those contracts just because of the global financial crisis. So the US government jumped in, bailed it out, and I think it cost the US taxpayers about $182 billion, which is a lot of money. But Peter Lehman was allowed to fail because it's an investment bank, but the government let them fail. So which one gets bailed, which one doesn't? Sometimes it's just not about the systemic risk. Sometimes it might have something to do with the political connection of the top management team as well. Yeah, so of course that's the topic for another discussion. But you know, bankruptcy is real, but sometimes the financial institutions get bailed out by the government. Um, to give you an idea of how real bankruptcies are, here are some of the examples of the companies that pretty much went bankrupt in the last decade. And also it gives you an indication of the total asset before they went bankrupt. Of course, we all know Enron. So the case of Enron that went bankrupt, because just a couple of months before it went bankrupt, the financial reports looked fantastic, and just I don't know, a year later, all of a sudden it's worth nothing. And of course, you heard of WorldCom as well. And Chrysler, which I talked about a bit earlier, after it was sold by Daimler Chrysler, it ended up with a bankruptcy as well. In Australia, of course, we've got some highly publicized bankruptcies as well. This is probably too far back for you to remember, but Ansett Australia, the airline, went bankrupt. And more recently, you've got OneTel, which is a telecommunication company. I don't know whether you can think of any other. There might be. There you go. So yeah, of course, there's a lot more other examples of bankruptcies as well. So how do we predict bankruptcy? Now, I mean, sometimes it's kind of hard to predict bankruptcy if you look at Enron as an example, because as I said, just the year before, everything looks fantastic, like the financial reports looks fine, everything's fine, and all of a sudden, just a year after that, the shares are like, paper, they're not worth anything. But this guy, Edward Almond, he came up with what we call a Z-Score. So the Z-Score is used to predict bankruptcy. Now, of course, it's not foolproof, but it has a high level of reliability in predicting bankruptcy in the next 2 years. This Z-Score was developed in 1968, and we're still talking about it. So obviously, it has to be working relatively well. Overall, the reliability level associated with the Z-Score is about 72 to 80%. So it can predict correctly maybe 78 to 80% of the time bankruptcy. So how do we actually calculate the Z-Score? Now, I think the beauty of the Z-Score lies in its simplicity in construction and interpretation. Now, it's really easy to calculate the Z-Score. All you need is information of the financial reports. So all this information are publicly available. So essentially, you just need, working capital, total asset, return earnings, earning before interest and tax, market value, book value, that sort of thing. So all this information are quite publicly available. So to work out the Z-Score, you just need all these variable, times that by the coefficient, add them all up, it gives you a Z-Score. Now the first Z-Score is for a public companies, and the second Z-Score is for a private company. Now with private company, we might have a bit more difficulty getting all these informations, but certainly they're available. So the difference between them, now all these variables kind of stay the same, but the coefficients vary slightly. So here I've got 1.2, and then here I've got 0.7, and so on and so on. So the calculation is quite simple. The interpretation is quite simple as well. For a public firm, if the score is 3 or above, you're fairly certain that the company will be safe in the next 2 years. There's little chance that it will go bankrupt in the next 2 years. If it's 1.8 or less, then there's a real chance of bankruptcy there. Doesn't mean that it will go bankrupt, but it has a high risk of going bankrupt. And of course, you've got the grey area between 1.8 and 3, where it kind of go either way. And the interpretation for a private firm is very similar as well, just different threshold. You've got 2.6 and 1.1, but the interpretation is pretty much the same. So I guess the beauty of this Z-Score is simplicity in calculation and interpretation. So I think that takes me to the end of this lecture. I'm glad that I still have a little bit of my voice left. Thank you for your patience, and I see you next week in the revision lecture. I'll be uploading some things by the end of the week, which is pretty much tomorrow or Saturday. Thank you.